Good afternoon and welcome to the Expat Academy webinar with BDO on the tax challenges and opportunities for companies moving employees to work in Africa. I'm Linda Brennan from the Expat Academy, and with me today is James Hourigan from BDO's Global Employer Services team, who leads BDO's Africa Advisory Service desk. James is now based in London, but worked in Africa for many years, and he's going to be joined by some other colleagues today on the ground. I know you'll get some great insights today, and please put any questions you may have in the Q&A box as we go along. We'll try to cover them today, but if we run out of time, James will be happy to pick them up with you after the meeting. We will be recording today's session, and this will be made available to you later on. So, without further ado, I'd like to hand over to James.
Thank you very much, Linda, and good afternoon to everybody. Natalie, you can go on to the next slide, please. Okay, so I'm James Hourigan. For those of you who don't know me, I'm part of our London-based, UK-based, indeed, Global Employer Services team, and I'm specifically working in our expat team. We spend pretty much all of our time keeping people compliant, whether they're coming to the UK or indeed whether they are going out on secondment to somewhere else in the world, including, of course, countries within Africa. Part of my role is leading our Africa Advisory Services desk in London, where essentially we are assisting UK businesses navigate their way into Africa and ensuring that they're compliant and they're doing things in the most tax efficient and cost efficient manner, either whether they're going into Africa for the first time or indeed they're expanding their footprint further. I'm delighted to be joined by a number of my Africa colleagues today. I will introduce them individually as we go along at the appropriate time, but it's great that we're going to be, they're going to help me unpack some of the opportunities and challenges that businesses, whether they're UK or indeed businesses from whichever other country, are deploying people into Africa, be it on a short term or indeed a longer term basis. So we're going to cover all the 4 regions. I will also have with me today, we'll spend some time chatting with one of our regional leaders in Africa, Sandeep Kapre, who I know is away in Asia at the moment, and it's gone past 10 o'clock in the evening for him, but very glad to have him join us today. If we can just move to the next slide. Okay, great. So Africa. I went there for the first time, and I went to South Africa for the first time in 2003, and I fell in love with the country so much. I engineered a secondment with KPMG many moons ago in 2007. It was supposed to be an 18-month secondment. It turned into pretty much a 14-year stint in South Africa. So it kind of gives you an idea of what I thought of Africa as a whole. I didn't know it at the time, but moving there, I quickly realized that South Africa was one of only 54 countries. And I guess there's some disputed territories there as well with Western Sahara. So some people will even say 55 countries, but let's go with 54. All of them with their own tax system. So you can just imagine the difficulty one has at trying to ensure that they're compliant, depending on which country they're actually going into. Some interesting facts about Africa. Certainly those of you who are wearing diamonds today, you probably, if you look at them, you probably realize that there's a very good chance that they originated in Africa. Africa has a lot of firsts, and it has the longest river in the world in the Nile. It basically makes 70% of the world's cocoa beans, and I know my colleagues in Cote d'Ivoire will be quick to tell me that their country is the main reason for that. The Sahara, which those of you who travel into Africa will go over on those nighttime flights. It's almost the same size as the USA. Maybe just going on to the next slide, please, Natalie. Just some other interesting facts about Africa. No, we go back. Thank you. there's one that I didn't know until, well, a lot of these I didn't know until I spent a good bit of time there, but close to 2,000 languages spoken in Africa. And I think if I chat with my colleague Gideon, he'll tell me that quite a reasonable percentage of those 2,000 languages actually are found in Nigeria. And he was minded to tell me you could basically have two villages 5-6 kilometers apart, and if they speak, they have their own dialect. So of course English is the common language. So that's what basically facilitates people understanding each other. But I think there's like something like 300, between 200 and 300 languages spoken in Nigeria alone. I think another interesting one there is that it is home to the world's oldest university. I think it pips one of the European universities, the University of Bologna, by a few hundred years, but that's 859 AD by all accounts. Okay, if we could just move on. Thanks, Natalie. So we wanted to just kick off with just a few questions, which Natalie is going to post, just to get a sense from you, the audience and the owners of assignment populations. What's happening? What are you seeing? What changes perhaps are you seeing since the pandemic? But it would be good if you could vote, just provide your answers in relation to each of those three questions. Okay. Natalie, have you got answers coming through there, the results? Wow, interesting. The first one is, yeah, it's interesting. But equally, it's interesting, the answer to the third one, where you're also seeing an increase in the hiring of non-employee, of say non-UK employees. Certainly an increase there. So I think what this demonstrates to me, though, is that Africa is open for business. And I mean, we're living in a different world now with remote working and everything else. But as one of my colleagues is quite often quick to point out to me, someone's got to build the bridges, and someone's got to build new things. And I think we do see that regularly. I think it's fair to say, certainly in my time in Africa, a lot of cranes, a lot of infrastructural spend, and looking at these results, I don't think it's any different. Okay, that's good. Thanks, Natalie, for that. If we could just move on. So opportunities and challenges. There's a lot. I mean, when I'd been asked before, and this is even indeed in my time when I worked in Ireland, can we just pay X amount in the local country, through the local country payroll, and keep Y amount offshore, because we don't need to spend it all in country. And maybe for exchange rate reasons and everything else as well, you want to keep the money paid into an offshore payroll or a home, bank account. Don't we only pay tax on the amount that's paid in country? I think you'll find, like, that was one of the myths for me. I think I've found for sure that the Africa tax authorities are a lot more sophisticated than that, and a lot more aggressive, and ensuring, just like a lot of other countries, that they collect the revenues that are due to them. And I think with transfer pricing becoming a lot more widespread as an issue across Africa as well, I think tax authorities are much more alert to what the issues are. And I think you'll find from my chats with some of my colleagues today that regardless of the location of payment, of something, of the remuneration, if it's attributable to the services performed in country X, it's taxable. So hopefully you're going to find out a few new things today. If we can just move on, Natalie, please. So I talked about 54 African countries, but what's interesting is less than half of them have a double taxation agreement with the UK. So why is that important? Well, it's important insofar as, from an employment income perspective, it's important insofar as you are reliant on the in-country tax rules for for basically 30 of those countries to determine the extent of what your tax exposure for your assignees is in that country. And what it also means is that the 183-day rule is a myth. It doesn't apply per se for any of those countries. It's possible that the clock is ticking from day one, and you potentially have a payroll obligation in respect of people you've deployed to that country from day one. And that's whether you've deployed them for 3 months or you've deployed them for 3 years. So that's something that it tells me. I think what's interesting there as well is if you look at that map on the right hand side, that's the map of Africa. It's too small. If you look at that island jutting out there down in the southeast corner is Madagascar, and there's some small islands to the right of that. One of them is Mauritius, believe it or not, and we need to magnify to have the red come up there. But we do have a double taxation agreement there. If we could just move on to the next slide. Please, Natalie. So if we focus in on the 24 countries where there is a double taxation agreement, it is possible to avoid a tax exposure in one of those African countries, but it's subject to all of the following conditions being satisfied. I'm not going to go through each of them individually, but I think what's important there is if we look, first of all, it's a precursor that they've got to be tax resident in the home country. So let's assume you're sending people from the UK and they've remained UK tax resident under UK law. Then they've got to satisfy conditions 2, 3, and 4. It's not an either or, it's all of them. You've got to satisfy all of them. And if you look at 2, for example, there's a number, and I have a note 1 there. There's a number of countries where, and these were double taxation agreements that were negotiated back in this, well, before the 1980s or early 80s. At that point, the rule was typically, the condition was 183 days in the tax year concerned. Through later double taxation agreements and through probably some taking advantage of that 183 days in the tax year concern, let's say, they extended it out to 183 days in any 12-month period. So it's more difficult to qualify for the exemption. But I think what we're saying here is that it's not the same for every country. You've got to apply the particular rules of the double taxation agreement for the particular country or countries that you've got people deployed in. I think also that, look, one would expect with transfer pricing, with permanent establishments and all of the rest, one would expect that those, well, certainly under OECD arm's length transfer pricing principles, that the remuneration costs for those particular employees would be attributed, would be charged to the permanent establishment. And that effectively rules out the ability to claim exemption in the first place. If we can just move on, please, Natalie. So we've talked briefly there about the tax, but Social Security is something else that's also relevant. Now, look, you typically pay Social Security where you work. We know that. The UK has different rules depending on whether it's someone from an EEA country, whether it's someone you're sending people to a country with which the UK has a bilateral Social Security agreement, or indeed the third category, which is the rest of the world. The UK has Social Security agreements, I think, roughly 20 countries. One thing I would say there is that some countries are relaxed and they will afford a concession. It's not all of them, it's some of them, whereby they won't enforce Social Security in their particular jurisdiction where they are satisfied that the individual is contributing to Social Security in their home country, in this case, the UK. Now, the UK rules are quite simple. We've got a 52-week rule for outbound assignees to those rest of the world countries. and effectively you would remain liable to class 1 national insurance contributions in the UK if you basically satisfy 3 particular conditions. That basically the employer has a place of business in the UK, that you were living in the UK immediately before starting the assignment, and that you're ordinarily resident in the UK. Now, ordinary residence there is really talking about, you know, where you have a regular and settled mode of life. I think that's the way HMRC coin it. Now, clearly, if you're sending people on secondment for a temporary period, one would expect, and let's assume those 3 conditions are satisfied, well, then you've got the 52 weeks obligation, regardless of what Social Security may or may not be applicable in the African country. If, on the other hand, you're effectively sending someone out long term and you know what, they're actually taking up employment with a local entity, well, then, you know, one would expect then that they would come off UK Social Security from the beginning. They're not being seconded. They're effectively migrating elsewhere. Well, then you would expect that they would enter the Social Security system of that country straight up. But it's something to be mindful of, because that second point there, it could create additional, I call them hidden assignment tax costs. If you don't do your homework, these are the kind of things that can hit you. Social Security rates vary from country to country. Some of them have nominal thresholds, earning thresholds, so they're not going to break the bank. But others, you can potentially be liable for a percentage of salary on the full basic salary with no de minimis, with no earnings threshold, to basically alleviate the cost burden there. Natalie, if you could please just move on to the next slide. Okay, just to give you a quick idea of BDO's Africa footprint, we've effectively got legal presence. We've got a presence through best friends, through other firms that we have used, and my 14 years in South Africa and pretty much the last 5 with BDO in South Africa. We would use independent firms that we've used for years. So essentially, we've got presence across the continent. We've got formal legal presence, as you can see from that slide, particularly down the southern and eastern parts of Africa, but also further up north. But pretty much what we have is, we can move on, Natalie, please. These, I'm just going to let you, these are more for your reading. But pretty much we have a presence across the board, and I know from handling, dealing with my colleagues before, when we're handling particular queries in countries, and because of, particularly in some of the countries where they operate on a source basis, the rules are quite similar. So our colleagues in certain countries in Western Africa, for example, are pretty much equipped to handle the queries that would arise in respect of some of their neighboring countries. Okay, Natalie, we can move on to, keep going, please. Sorry, we can come past those slides there. They're just for, okay, and there's just giving you details of all the services that our Africa team provides. But I think just one thing for me here, it's very much about we join up. We provide a service on a joined up basis. I think what makes sense is, particularly, and I've seen this fail, I've seen where a UK client has come to me when I'm sitting in Johannesburg, we need help with A, B, and C. And if only they had done certain things before they had sent people from the UK, we could have avoided a lot of the problems and wouldn't have had to try and remedy stuff and try and get rid of penalty charges or plea for alleviation there. So I think that's utopia for us, is that we basically join up from the beginning and provide the right advice, so that clients are geared up for success and just get on with their business then, and the assignees can get on with their business rather than having to worry about tax issues 1 or 2 years into a secondment. Okay, so before we go to Mauritius, I'm going to just, Sandeep, if and thank you again for joining us at this late hour. I think what would be good to understand from yourself. I'm just going to, if I may, just to help our audience understand what's happening in the African landscape, just some questions. In terms of, what's your current assessment of Africa from a business perspective? And I guess maybe the answers to those polling questions were quite interesting.
Yeah, no, James, obviously the polling question gives you an indication as what's happening in Africa. There's a lot more presence of foreign FMCG companies and large players coming into Africa. Of course, people in the mineral sector, oil and gas, etc., of course, but also you're seeing manufacturing coming back into Africa after whatever has happened in China. There's been a secular growth trend in terms of population. There's been a secular growth. Some of the fastest growing countries in terms of GDP are in Africa. And the fastest growing population outside, say, the Middle East is in Africa. So with that, obviously, Africa starts becoming a lot more attractive to multinationals, and therefore you see a lot more traction in terms of employees coming from abroad and working in Africa.
Yeah, and in terms of and sorry, I would validate that nothing seems to have changed in the past few years then since I've relocated to the UK. I mean, it's still very much expansion mode, whether there's a pandemic or not. People find a way to get on with things. In terms of, I touched briefly on the the tax authorities in Africa and the fact, that they're sophisticated, etc., and ensuring, that they have robust tax collection systems. But in terms of their approach at the moment to tax and collection of same, what do you think?
Yeah. Different countries, again, you kind of made the point, right? Different countries, there are 54 odd countries, and each one looks at things fairly differently. Some of them are the ease of doing business is much easier. Take into consideration countries like Kenya, Uganda, Rwanda, Ethiopia, etc., which are at least Rwanda, if not Ethiopia, and South Africa, Ghana are easier jurisdictions. But Tanzania, for instance, can be difficult, right? Similarly, when it comes to tax authorities, some tax authorities are very sophisticated, some tax authorities are still struggling, right? And again, you take Anglophone countries, Francophone countries, and Lusophone countries, they all kind of have different systems, but however, OECD rules apply in regard to international taxation, TRS, and transfer pricing. So they pretty much follow that. And one would basically, your interaction with the revenue authorities, if you have strong partners like ourselves, BDO on the ground, you would be able to navigate the situation much easier. But the secular trend, again, is from systems, technology, people, process point of view. The tax collection and the tax and the revenue authorities are getting fairly sophisticated in Africa.
Okay, thank you for that. In terms of attracting, a lot of countries there, and I think even of Ireland back in the day, attracting foreign investment from the multinationals, lowering tax rates, etc. In terms of, we're 54 countries, but if we just took a helicopter view of Africa, if we could, just in terms of inward investment, the general themes that you're seeing, either tax incentives for individuals or indeed for the corporate themselves, what's typically out there?
Yeah, on a corporate scale, of course, tax holidays and investment in specific sectors, preferential tax rate for international companies with their regional offices in our countries, in our local countries, that fulfill certain requirements, or certain sectoral investments, obviously investment allowances, accelerated depreciation, sometimes some relief in import duties, or deferrals of tax liability, etc. Those things can be at the corporate level. But to a tax resident, there can be tax reliefs, credits, or exemptions, especially for non-citizen individuals employed by international organizations, right, like United Nations or any organization that has signed an agreement with foreign governments and local governments. Those ones, definitely there are some tax reliefs available.
Okay, so I think it's about the business, the company doing their homework, making sure whether they're, going in for the first time, dipping their toe in the water in Africa, or indeed expanding their footprint. Do your homework, make sure you're getting bang for your buck, and you're, because I guess you need to do some of these things as you're entering rather than trying to do something retrospectively.
Sure.
Okay. And in terms of current trends in global mobility, we've so much with remote working and everything else, but I guess maybe the polling has helped the answer already. But what are you seeing? Are you seeing big increases in particular jurisdictions? I mean, I know you're on the East African side. Maybe it's easier for you to talk to that particular region, which is a big region in itself. What are you seeing? What are the trends?
Yeah, as I started off when I started with my first answer itself, I mentioned to you that one is seeing many more companies coming into Africa, right? Traditionally, people who would really not have much of a presence in Africa or would operate out of, say, Dubai or out of London, and you can start seeing many more players having either a liaison office or a small presence. They may have their quality assurance person, but toll manufactured out of somebody else. So you're seeing many of those type of movements into East Africa and Africa in general. You're also seeing a larger presence of international financial institutions, DFIs, etc. You're seeing more private equity funds operating, and they also, with their DFI as their LPs, some of them are actually having a stronger presence in East Africa and Africa in general. So it's the whole spectrum, and one definitely sees, even from our point of view, in terms of the number of clients we actually handle, we see a fairly strong growth.
Okay, and in terms, just wrapping up then, and thank you for that. Just in wrapping up, I mean, key takeaways. We haven't touched on immigration yet. Maybe just a few words on immigration, and in terms of, before relocating, well, maybe for the individual, but be helping staff relocate to an African jurisdiction, just some kind of tips. If you could maybe just finish up with those two, just briefly, that would be great.
Yeah, again, as you rightly put it, do your homework, right? I mean, do your homework, speak to people, try and understand what it means to kind of get into the jurisdiction. Typically, what do companies look at, right? They look at safety and schools, availability of other embassies in case you've got to get your visas, airline connectivity, any growth opportunities in those markets, regionalization. There are obviously a lot of regional blocks, quality of life, weather, restaurants, typical expatriate community and expatriate living. Schools is a big one, especially for people with younger children, and what it means in terms of graduating and getting into great universities after that. So all that is typically what people see, apart from obviously tax compliance, permanent establishment, and any other issues that might come about. So that is typically what I would suggest. And obviously there are some things that you may want to see, especially if you're an American citizen. Look at the advisories from your governments, or sometimes in the UK as well, because sometimes some countries, they do not allow family postings to be done, especially for DFIs, etc. And so that can create its own problems. So one has
Sure.
to not only look at, the taxation, but the other areas as well.
Okay, fantastic. Sandeep, I know we could go on for another half an hour talking about the do's and don'ts, but we have to press on. And I really thank you very much for joining us today. Thank you.
Thank you.
If we can just now bring in Gilbert from Port Louis in Mauritius. Hi, Gilbert. How are you?
Hi, James. I'm fine, thank you. And you?
I'm very well, thanks. And I certainly learned as we were discussing this webinar briefly last week. I know I've learned something very new about Mauritius with the visa reform. So without further ado, if we could, Natalie, if we could just go on to the next slide. So I think this was very interesting, and I'm not necessarily encouraging our audience to have all their employees suddenly relocate to Mauritius, but I think it is interesting nonetheless. The certain carrots that have been attached to this premium visa option. Do you want to maybe just take us through this slide?
Yes, the government introduced the premium visa 2 years ago during the pandemic. So they wanted to attract people coming to Mauritius. So anybody who wants to spend quite some time in Mauritius could apply for the premium visa and stay in Mauritius for at least 6 months. And the visa can be renewed annually. So somebody who wants to work from Mauritius, remotely from Mauritius, it is possible for him to do so. He can come to Mauritius with his family. And for his income, if his income has already been taxed in the country of source, it won't be taxed again in Mauritius. So whatever he transfers to Mauritius into a bank account in Mauritius, he can make a declaration that the income has already been taxed in the country of source and is not being taxed again in Mauritius on that income. The person can also spend his money through debit cards or credit cards, foreign credit cards, and these amounts also are not considered to be income derived from Mauritius. It won't be taxed on it in Mauritius. So it is only taxed in Mauritius if his income has not been taxed in the country of source or in his country of residence. And this amount is transferred to a bank account in Mauritius.
Yeah, I think it's very interesting as well that there's no permanent establishment created for the foreign employer, regardless of who he or she is, what their role is, seniority, etc. I think it's very interesting that Mauritius has facilitated this, and as you said, I think you highlighted to me there's been a reasonable uptake of this premium visa option in the past few years.
Yes, during the last year, there have been many people who have come to Mauritius under that scheme.
Okay. Could we maybe switch lanes? Natalie, if we could just go on to the next slide, please. So if we take more just those who are lucky enough to get their premium visa, good luck to them. But I think for the vast majority of other people, they're not going to Mauritius, or they're not being sent to Mauritius as a remote worker, so to speak. They're typically going on assignment, working on a particular project in whatever sector that may be, whether it's financial services, whether it's professional services, and so on. Maybe if you could just talk us through this slide, that'd be great.
Okay, so for a foreigner to be able to work in Mauritius, if he's not on a premium visa, he will have to obtain an occupation permit first before he can work in Mauritius. So it's the local employer who will make the application on his behalf with a local contract of employment. So when he gets his occupation permit, when he can come to Mauritius with his family to work in Mauritius. In this case, any income that he derives while working in Mauritius is taxable in Mauritius, whether the amount is paid in Mauritius or paid overseas. It's taxed on the whole amount. And the rate of tax is 15%. for income exceeding £19,500. There's also a solidarity levy for high earners. So if somebody has a chargeable income, that is his salaries less these personal deductions to which he's entitled, and if that amount exceeds £60,000 for a year, he's subject to solidarity levy at the rate of 25%. But there's a cap of 10% of his salaries. That's a maximum that he's going to pay for solidarity levy.
So basically the more you earn, the more you will pay. There is effectively the
Yes.
reality. But as you said, it is particularly leaning towards the higher earners. So just from an expat concession perspective, clearly, just if I just allude to the first slide quickly, Mauritius is one of those 24 African countries with a double tax agreement with the UK. And interestingly, it's one of the older double tax agreements. It has the 183 days in the tax year rule as applying. But again, if you're creating a permanent establishment in the country, if the costs, the remuneration costs are effectively sitting in Mauritius rather than in the UK, you're typically going to have a challenge with trying to claim exemption under the double taxation agreement. Gilbert, you mentioned to me there, if you maybe we'll just touch briefly on, you mentioned, look, there are, and I've seen this with other African countries as well, and indeed, employer contributions to a foreign or local medical scheme. There's no employment tax issue there, and as you pointed out to me, there's an ability also to use up money on overseas flight costs to the extent it doesn't exceed 6% of the employee's basic salary, isn't that it?
Yes, that's right. Yes, these amounts are not taxable for the employee.
Yeah. So I mean, I guess for a UK employer sending people on assignment to Mauritius, look, the 183 days is relevant, I guess, in some respects. It very much depends on how long they're sending people to Mauritius for, but I think they should be taking advantage of the tax concession on the home leave flight costs, and equally the fact that, look, assuming someone is still able to remain in the UK medical insurance plan, assuming it's a UK one, and also or the UK occupational pension scheme, that the employer contributions to both of them, whilst the employee is on assignment, secondment to Mauritius, should avoid an employment tax charge in Mauritius. I think that's the bottom line, right?
Yes, that's right.
Okay, I think that's great. I think, thank you, Gilbert, for, I know you've got another appointment, so I'm not going to hold you on this evening. If any questions come through later on Mauritius, I'll be sure to make contact with you, but look forward to catching up with you soon, and thanks very much for joining.
Okay, you're welcome. Okay, bye-bye.
Bye-bye. Okay, moving a little bit westwards to, well, kind of northwestwards to Kenya. Steve, how are you?
How are you?
Yeah, I'm very well. Thank you. So Kenya is another one of those countries with a double taxation agreement with the UK, and indeed it's a country with many expats, right? From pretty much all parts of the globe. I think Kenya has been one of those countries where there's been a lot of investment in certainly in my time in Africa. I think there was a lot of investment from the East, from India, from China. Would that be fair? Probably not exclusively, though.
Yeah, there has been increasingly large amounts of investments coming from the East, from China, from India, and through the United Arab Emirates. Okay. But traditionally, the bulk of FDI into Kenya and into the East African region has been from Europe.
Okay. Natalie, could we quickly just move on to the next slide, please, first? Okay. Steve, over to you. If you want to just give our audience, our listeners, just a I guess with your Kenyan hat on, but then equally perhaps just with your East Africa hat on, that when it comes to immigration, because I've heard of stories before where people can be deported. I've seen it in Mozambique as well, in South Africa. Maybe just tell us what it's all about in East Africa from an immigration perspective.
So in terms of immigration, East Africa is a much friendlier zone compared to some parts of Africa. Deportations is something that is extremely rare. It only happens in the event that someone has been cited for a criminal misconduct or some extreme forms of misconduct. So it's not something that administratively the governments actually pursue, because that will be counterproductive in terms of attracting foreign investments and keeping the multinationals comfortable or doing business in the region. However, in Tanzania, 5 years ago, there were instances where people were deported from companies that were facing revenue audits or that were facing disputes with the government. Actually, expatriates their visas, their work visas were cancelled, and some people were asked to actually leave the country, including senior or people in companies. So that was the only time that this was witnessed. It was a stint in that country's history. It was also not something that was at that level before the term of President Magufuli, who passed on. And the new president actually rolled back those policies and said that people can actually work in Tanzania if they're providing value and contributing specialized skill, or are managing companies where people were multinationals or foreign investors have actually invested in the country. So that's not something that is common, but it happens sometimes in the history of this region, in the recent history of this region.
Okay, thank you for that. Natalie, if we could just move on to the tax side. I think, again, it goes without saying, if we just covering the employment tax issues, but just the first point, I'll just cover it quickly in terms of, again, we're referring to DTA exemption, and it's about, it's about assessing or taking the appropriate advice to assess, to the extent, if at all, you can claim exemption from an employment income tax charge in Kenya by virtue of the employment income article contained in the UK-Kenya double taxation agreement, for example. The same principle would apply for other countries in East Africa where there's a double taxation agreement. But I think what I found from our interactions was that, look, if you don't, well then, you've got tax issues. And even when you're a UK employer seconding people into Kenya, you can have payroll obligations, right?
Yes, so you will have payroll obligations, but the DTA is actually strongly respected in Kenya, particularly, where it's stipulated clearly that your employment income is not subject to tax in Kenya under the DTA, then that is strictly respected by Kenya Revenue Authority. There is a provision in our income tax law that gives precedence to the double tax treaties that the country has actually signed, and the template actually applies in the region. We follow largely the OECD model in terms of the DTAs that have been signed by Eastern African countries and foreign countries, more particularly the UK and European countries. So the DTA is strictly respected. If you are going to be coming to the country to work for 3 months, for example, in a year, or you are going to be working in Kenya for less than 6 months in a year, then under the treaty provisions, your income earned from that employment activity will be taxed in the UK rather than in Kenya, and that's strictly respected. There are also other agreements that are there between specific countries and specific multinational organizations that have secured special arrangements with the government that gives relief or even exemptions to expatriates who are working in Kenya. And those ones are also respected strictly.
And can some of that be in respect of certain sectors, in respect of certain projects, like government infrastructure projects, or is it more widespread than that?
Those ones are generally based on actually agreements that have been sponsored or signed between governments. So you find there are specific donor-funded projects or specific donor-funded activities that people are coming specifically to work in those ones. Then you will find in the agreement expatriates being exempted. Those ones are for specific activities and specific organizations.
Okay. So thank you for that. Understood. I think the message though for our audience also is that, look, for longer term secondments that are going beyond 6 months, where there is no other inbuilt exemption, you are going to have to pay Kenyan tax. You're going to have to be registered for payroll taxes. Like any other country, there's typically penalties for non-compliance, but I think what you'd said to me before is, like, look, like our neighbors, Uganda and Tanzania, Kenya equally, you know, there is the ability to go to the authority where you've made a mistake, get to them first before they get to you in an audit, and that clearly will give you a better result, and is clearly the approach to take, where you have inadvertently just got things wrong and you've now been advised later on that fact.
Yeah, that always comes in handy, especially in terms of waiver of applicable penalties and interest. So if you make a voluntary declaration to KRA, you prepare, you come to a firm of tax experts like ours, and we do a tax health check, and we pick out the compliance lapses, and we put it in a report, and we share that with the authority of the client. We share that with the revenue authority, and we have discussions, and they review the paperwork. Then we process the exemption from penalties and interest. But of course, the principal tax, which was not paid, has to be paid in full. Yeah. Okay, understood. And Kenya is one of those countries. I appreciate, and I think Uganda, you'd pointed out to me previously, is similar, where if someone is paying Social Security or contributing to their Social Security of their system of their home country, that I think Uganda, there is no Ugandan Social Security, and equally with Kenya, I think there is this kind of, it's more relaxed approach, and certainly if someone is not coming for the longer term, you know, so to speak, so long as there's Social Security being paid somewhere, I think the government is quite relaxed there. I think that's what I understand. But you're one of those countries where, well, first of all, is that pretty much it on the Social Security side, or? Yeah, it's pretty much relaxed in Kenya. It's pretty much relaxed the way you've captured it, but Tanzania is not the case. You may have to actually pay as much as 6% of somebody's fixed income as Social Security contribution. So Kenya and Uganda are quite relaxed, but Tanzania is very strict, and even Kenya is likely to also increase the rate of contribution in the next 1 year or so. There is current discussion that is going on between the government and the private sector players as to what that incremental will be. There is a proposal for 6%, there is a proposal for 3%, so it's split. Whatever will be agreed upon will be split between the employer and the employee in terms of contribution. So I actually expect there to be a change in this regard in the next 1 year, or within the second half of next year.
So it might be something then that is more material for foreign employers in the future as they consider deploying people into Kenya. And I think it's fair to say that look, we both know that there's lots of countries in Africa that operate on a source basis, and if all the taxable income for the particular country is collected through the payroll, that the employee is effectively absolved from having to file a tax return in that particular country. I think obviously we know there's other countries, and we just touched on Mauritius as one, South Africa another, Kenya would be one also, where Botswana, where there would be an obligation or expectation to file the employee, the individual themselves, to file the annual tax return.
Yeah, exactly that.
Yeah, so I think just for our listeners, it's important to know. I mean, you will find, you know, particularly again with 54 countries, it's more countries than there is in Europe, to put it into perspective, even with the, you know, all the breakdown of the Soviet Union and so on. There's different rules, and you might have expats in different parts of Africa where tax returns are required in some jurisdictions and not in others. Okay, can we just, Natalie, can we just move on to the next slide? Steve, I'd really like you to cover, we may not have time to cover everything here. I think it's pretty you know, our listeners will be able to understand or follow the first 2 points fairly easy, but if you could just explain the third point, because I think this is interesting. So this is the 1/3 employment income exemption. Could you just give us a practical, just really briefly, just a practical scenario of Mr. or Mrs. X, Miss X, coming from country Y to Kenya? Here's how it works.
Yeah, so this is a situation where somebody is actually providing his services in the entire region. So you are not just working in Kenya. It's a shared resource, let's say a regional or CFO who is supporting activities in Kenya, in Uganda, in Tanzania, in the whole of Africa, and is probably seconded from the regional office, which is the UAE or the UK. So if somebody is actually not particularly located fully in one country, then 1/3 of his income can be exempted from tax, and then the remainder is actually taxed in the country.
Okay, but the employer should not be then claiming the costs as a tax deduction, right? That's yes. The deal. So you can't have it both ways, so to speak. Okay, very good. Steve, I know we could go on forever. There's lots of issues in East Africa, but I have to move on. Thank you very much for your time. Really appreciate it. Dumisa, good afternoon. Thanks for patiently waiting. How are things in my former home, South Africa? Is it another warm day in Africa? It was pretty miserable here first thing this morning in London, but the sun eventually appeared.
Yeah, it's actually pretty warm. It's currently 25 degrees as we speak, and time is almost 6 o'clock in the evening.
We've all got our fingers in our ears. We don't want to hear that. Anyway, Natalie, if we can just move on first of all. Just taking global mobility trends, Dumisa. I know we've had quite a bit of interaction around all of this, but try to maybe cover it just on one slide. I think what it's fair to say, what you've said to me is, look, we're seeing I'm seeing a lot of clients with people who maybe Steve just alluded to regional roles. We've got people who either have regional roles or maybe they're doing virtual assignments now, but they're sitting in some part of South Africa in fulfilling that role. Is that it, pretty much?
Yes, James. I mean, as we've spoken, I mean, which is what I think Steve as well, they're experiencing, is that we're finding quite a lot of individuals that would have regional roles supporting the whole of the southern region, and because of the proximity, they tend to want to work mostly from South Africa. And what that means is that we're seeing quite a lot of these remote working arrangements as opposed to the traditional long-term assignments, which, as you know, it used to be about 5-year visas, and now our authorities have clamped down on those and quite limiting those by introduction of quotas as well throughout the region.
Okay, interesting. But of course, there is the. I mean, for our listeners, there is, you know, it's obvious. They need to be linking in with their colleagues and on the financial side or on the tax side, and just be mindful You know, if it's someone on the global mobility side, for example, just be mindful that there could be wider tax issues before agreeing to, you know, allow people basically remote work in South Africa, for example, or it could be any other country for that matter.
Yes, and
Okay.
that's correct, James. I mean, there's a huge potential of creating a permanent establishment, and
Yeah.
also, as you mentioned earlier, I think when you're speaking to Sandeep, the potential of transfer pricing as well. And
Yeah.
with our Africa Tax Authority Forum, there's quite a lot of information sharing and then intelligence sharing as well to just pick up all of this, the movement of individuals as well as capital throughout the African continent.
Okay, thank you. Natalie, if we could just move on. I think Dumisa, if you want to just take us briefly through this slide, just from a tax and an immigration perspective.
Yeah, I think, yeah, I mean, my colleagues have stressed the importance of firstly obtaining a visa if you're going to be doing work in the region, and it's very important to obtain the correct route visa, especially if you know you're going to be spending a lot of time, is to make sure that other than an interfirm visa, if you need to spend more than 2 years, maybe a critical skills visa, maybe the correct visa to apply for. To ensure that you are in South Africa or in any other country throughout the period. Because as Steve did mention, we've also seen a few instances. One of them was in South Africa, where quite a senior member of a UK entity actually had to be sent home and was deemed as an undesirable individual and was not allowed in the country. Yeah, it was quite concerning. To have such a senior individual being turned away.
And I think the challenge with that is that the black mark that goes on the file, then that the company is associated with it, because if the company then wants to go, you know, we both know this, the company wants to go back in and expand further, and then they decide, you know what, we need to send 20 people in. It's not going to be that simple. It's not going to be as simple, perhaps, securing the visas in a timely fashion, eh?
Yes, that's correct. And James, what we find is that once you have, I mean, quite good relations with our Home Affairs department, it makes it easier when you don't have that black mark against your name to get visas for individuals. Yeah.
No, of course. Natalie, could we just move on to the next slide, please? I'm not going to cover everything in here. Like it's obvious again around the exemption criteria, checking that. I think though something, and I think the third point again we've alluded to earlier. Don't be lulled. I think we'd be saying don't be lulled into thinking that well, if we pay X amount into the South African payroll, sure, that's enough. That's not how the real world works. And with transfer pricing, with corporate tax deductions, everything else, I think it's fair to say to MISA, SARS, the South African Revenue Service, are alert to this kind of stuff. And the bottom line is, if you've got someone seconded to South Africa, it doesn't matter, a bit like what Gilbert told us, it doesn't matter where they're paid. If it's for South Africa, it should be declared in South Africa.
Yes, that is indeed correct, James. And I mean, there's quite a lot of mechanisms that our revenue authorities can pick up. And at times, you will find that there will be a recharge of whatever income is being paid in the home country. And by looking at the exchange control transactions, they can pick up that there's certain recharges, and they could compare that to what has been disclosed in country. So that is quite a high risk if the myth we have about only what is paid in the country is taxable in the country. They more or less use the accepted OECD model, which means that the source of the income is where the services are being rendered.
No, absolutely, Dumisa, absolutely. Thank you for that. Natalie, I just want to cover, I think, one other important point in particular. I mean, again, we could go on all day. We know there's expat concessions across various different countries within the Southern Africa region. I've seen, for example, Botswana, that you can even potentially get severance payments, gratuity kind of payments upon termination of employment. Sounds like a great place to work, where you can get that tax-free. I think we know, there's lots of countries that we alluded to earlier where there's exemption for medical contributions, medical policies, or indeed medical expenses, and the like, and indeed home leave passage is another one. But I think a big one from your side is housing. And if you wanted to maybe just, because I was there working there once upon a time as well, but I think if you could just advise our listeners, like if they want to get what is the exemption and how do they qualify for it?
All right. So South Africa recently changed their laws. To provide a concession, especially when you have those longer term assignments. And what our authorities are saying is that for the first 24 months of your assignment in South Africa, if you are paying accommodation as an employer, up to 25,000 rands every month is exempt. And what this means is that the lease must be in the employer name. And then for the first 24 months, you would get the exemption of 25,000. And if you're looking at the South African rental property, that is quite a good concession. It means that for 2 years, you actually pay no taxes on the accommodation benefit that you provide to your employees.
Yeah, no,
And
I think it's
and also relocation and at the start of the assignment and at the end of the assignment, and moving the personal effects for the expatriates, that is also fully exempt. It doesn't matter how much that is. And it's good you say that. When you look at Botswana has also quite some good concessions there, as you've said, around pension that are approved, medical gratuities after 2 years of service. Those are all concessions that are provided in Botswana.
No, thank you for that, Misa. The housing is interesting, especially because you could have people who are going on assignment from the UK for 2 years, and they could have housing taken out of the employment tax net from both a home and a host country perspective. Anyway, yes. And that is potentially not an insignificant cost, as you alluded to. Dumisa, thanks very much. I wish we had more time to talk more on Southern Africa, but I've got to move on to Mohammed in Egypt. So all the best. Thank you. Good afternoon, Mohammed, and thank you for your patience. I'm conscious we have 25 minutes to cover 3 countries, and I'm just going to wrap up at the end. So I'm going to try so as to have our listeners get the benefit of everything. If we could try and go and focus on the really important parts over the next 6-7 minutes, if that's okay.
It's with pleasure, yeah, and thank you for coming all the way from South Africa.
Pleasure, Mohammed. Natalie, can you please go on to the next slide? Thank you. Okay, global mobility trends. This was an interesting one for Egypt. Maybe a lot of our pollsters were a lot of the people were saying that they have people going to Egypt on secondment, but tell us this, because it's interesting stuff around the flying in and flying out as well of foreign labor.
Well, yes, we in practice, we do find a lot of flying in and flying out, especially when there's a short period of time for assignments to take place. However, over the last few years, I must say, there has been a lot going on in infrastructure projects like renewables, transportation, desalination plants, and other conventional electricity projects. Maybe you've heard that we are currently building one of the, if not the largest, solar park or solar farm in the world, which is down south of Egypt, which we call Upper Egypt because of the flow of the Nile. So that is a very, very popular project, and it's attracting quite a good number of expatriates. Of course, as you know, renewable projects during their mobilizing period and during their establishment period, it could be quite a long one, and hence attracting expatriates to stay for quite a long period of time. Nevertheless, over that time, sometimes there are technicians that come in and out, as you kindly called it, flying in and flying out during such periods.
Okay, okay, thank you. Natalie, if we can just, next slide, please. So I found this one interesting, Mohammed. A lot of countries kind of enforce the collection of the payroll taxes on the employer, either whether there's a local employer or they basically say the foreign employer has to register, etc. But in Egypt, that doesn't seem to be the case. Do you want to just maybe explain? So if you've got a foreign employer, let's assume the DTA exemption doesn't apply, right? And you've got an Egyptian employment tax exposure.
Yes, it's quite an interesting. So if the foreign employer does not have a permanent establishment in Egypt, right, and employs expatriates on a certain project in Egypt, then that means the foreign employer does not have a tax card or a tax ID or a tax file in Egypt. And since the payroll tax in general, when it's an obligation on an employer, it has to go through an employer that has a tax card or has a tax file. So when you have an employee that is employed by an employer that is a non-resident one, right, it becomes the responsibility and liability of the employee rather than that of the employer. In normal circumstances, should the employer be a resident employer, then it's, of course, the liability of the employee, but the responsibility of the employer. So in this one, it's very interesting, as you kindly mentioned. Yes, the foreign employer or the non-resident employer does not have an obligation towards deducting any salary tax or payroll tax from the expatriate or even from the local employee if they have one, even in Egypt.
Sure. And then, of course, I guess two things. Just for our listeners there, that third last bullet point on the slide, I mean, again, regardless of location of payment, you know, again, it's a myth. You know, don't be lulled into just, well, if we just pay X amount through the payroll in Cairo or wherever, that is sufficient. It's not sufficient where it's effectively a full-on Egyptian assignment. I think, Mohammed, you've made that point very clear to me last week. And equally, there's a tax return obligation, if you have a foreign employer. Is that right? The employee, or what do they have to do there?
Very true. Very true. So in the scenario where there's a non-resident employer, right, and there is an employee here on ground, the employee becomes responsible, as I earlier said, to pay the taxes on his remuneration. And he does that via submitting or filing a tax return on an annual basis, calculates the taxes. Well, the tax return would calculate it for him because it's all electronic now, right? And he would pay the tax liability and tax payable that comes out from that tax return. So that is very true.
Okay, thank you. So another evidence of another country where the payroll only option doesn't necessarily apply. Natalie, can we just move on, please? And I think this is more, I'm just conscious of time, Mohammed, but I think the bottom line is companies should take advice here. They should take appropriate advice. If they're sending people on a secondment to Egypt, I know I've heard that the housing, the issue of tax-free housing can be a bit challenging. It depends on particular circumstances, etc. But I think that the bottom line, if you were to, just a key takeaway from our listeners, what are you telling them if before they're sending people on assignment to Egypt, what are the two things or three things or one thing that they really need to do?
Okay, first of all, they need to check whether sending that employee would have the employer triggered as a permanent establishment or not, because that is quite critical. It's sometimes just a very fine line between that triggering a permanent establishment for the employer or otherwise. So that is number one. Number two, double check the fringe benefits and to what extent the fringe benefits will be taxable or not. Because the definition of housing is quite interesting. So if you give that fringe benefit to an employee that is, living in Cairo and just giving him housing allowance on his own, and it's a typical major city, and that's then it's going to be considered most probably as an additional taxable benefit. However, if he's working on an oil and gas rig in the middle of the desert, and he has to be provided housing by the company because it's, of course, in the middle of the desert, then that would most probably be exempt from being taxable. And there's some other stuff as well, like the mobile phone and stuff like that.
Yeah. So basically,
Severance
the bottom line.
payment, severance pay is quite tricky as well. You need to be careful that if you pay severance payment to an employee in Egypt, the exemption here is only if there is a resident employer.
Right.
So we need to be careful.
Right. Okay. Thank you very much, Mohammed. I wish we had more time, but we've basically got about 17 minutes left, and
My pleasure.
To be fair, I want to make sure that Gideon and Johanni have some time to speak as well. But thank you very much. Can we move on to the next slide, please, Natalie? Natalie, thank you. Gideon, good afternoon. Thank you for your patience. We're going to have to be fit and agile, the two of us here, in getting through this and make sure that our listeners get the key points. Nigeria, global mobility trends. You actually have seen a reduction in assignments, I think, is the message you gave me.
Yeah, thank you. Presently, we are in an electionary period, and this slows down business activities in Nigeria. Investors, would like to wait for the conclusion of the general election. And after the general election, they are going to take a decision on their business plans. And there are many business opportunities in Nigeria. And after election, business will pick up. So it will now increase the business, the mobility of staff or foreign expatriates to work in Nigeria.
It's interesting. It's an interesting one. Waiting to see who wins the election, who goes into government, and then investors will decide what they do next. Natalie, can we please move on? So I think in terms of the immigration, I think you drew the distinction for me, Gideon, that look, if we just took the really short-term assignments up to 3 months, we're just looking at a temporary work permit needs to be obtained, and that's pretty straightforward. But if you've got people you're bringing in for longer periods, well then you know, and allowing for the fact that there needs to be some time for the work permit to issue, you need to be processing applications early, and that the UK employer should, I think mentioned incorporating a Nigerian entity. So for our listeners, how long does it take typically for the work permit to process in Nigeria, ballpark?
But if the normal procedures are followed, it won't take time to process a permanent work permit. So it won't take time at all.
Okay, so it's quite quick to process.
Yes.
Okay. But
so
clearly they have to follow the checklist.
All right. And on the need to incorporate a Nigerian entity, the main reason is that if the UK company depends on a local partner to process a permanent work permit for its employee that will be coming to Nigeria to work, so there's every probability that the local partner will try to jeopardize the project that the UK company is executing in Nigeria, because that local partner will be, introducing some conditions to renew the permanent work permit of the expatriates. So that's why it is necessary for a UK company to incorporate a company in Nigeria that will process the permanent work permit for its employees that are coming to Nigeria to work.
Okay, thank you. Thank you for that. So that's something for people to note. Natalie, can we move on there, please? So I think here, again, this is Nigeria is no different. Again, we're talking about, you know, will they be able to claim exemption under the double tax agreement or not? Nigeria is one of those 24 countries. Nigeria is also one of those 12 or so or 10 or so countries where it's the 183 days in the tax year rule that actually applies when one considers the UK-Nigerian double tax agreement. But I think what's interesting for me there, Gideon, is the point around if the remuneration costs, you know, that there is an exemption from PAYE, but it's subject to certain conditions being satisfied. So it could be the case that, or could it? I mean, maybe just to clarify, you could qualify for exemption under the double tax agreement, but you might still have to operate PAYE and then claim a refund, or no?
Well, if the remuneration of the expatriate is borne by a PE in Nigeria, that is permanent establishment, the emolument will be subject to payee in Nigeria.
Full stop.
And if the expatriate spends 183 days in Nigeria and his emoluments are not borne by a PE in Nigeria, then the remuneration will be exempted from payee in Nigeria. Okay.
Yes. I want to just cover one other point on this slide, which I think, well, they're all important, but one thing just to hone in on. We've talked about, for the most part, individuals filing their own tax returns, whether it's South Africa, Mauritius, Botswana, Kenya, so on. Nigeria is interesting, and I've seen this before when I was doing a Pan-African review for a client. It's the employer that actually files the returns, eh?
Actually, the personal income tax provides that the employer should file all its employees' annual tax returns in January of the following year.
In January of the following year, right.
So it is the responsibility of the employer to file the tax returns as and when due.
And that's whether it's the UK employer or whether it's they've been seconded to a Nigerian employer. The same principle will basically still apply, assuming of course that the UK employer has a permanent establishment in Nigeria. But again, this is drawing out the difference. It's drawing out some of the nuances around different countries in Africa. A UK company could have expats in 5 different countries. And again, here you've got a situation where, okay, some the individuals have to file, others there's no filing. It's all done through payroll. And here we've got one where the employer has to do it. Interesting. Gideon, is there anything else? I'm just conscious of time because we have to bring in Johanny as well, and we're into our last just under 10 minutes left. Is there anything else that's really important to maybe highlight to a UK business sending people into Nigeria, or do you think it's covered in the slides?
Normally, the gross emoluments of the expatriates should be disclosed on the payroll. And when the expatriates arrives in Nigeria, it should be properly documented. Also, when the expatriate is leaving Nigeria finally, that the employer should get a delete form signed by the immigration service. So, because in future, when tax audit is carried out on the employer, that employer has to present the deletion form to confirm the time the expatriate left Nigeria, so that arbitrary assessments, will will not be imposed on
yeah.
the expatriates.
Okay, okay.
Yes.
Understood. So making sure that the authority, I've seen this as a problem in the US actually, making sure that the authority is properly informed of when someone has actually genuinely left the country and make sure that the paperwork is in place. Sounds like good advice. Gideon, thank you very, very much. I'm going to move just in finalizing now to our colleague in Ivory Coast. Johanny, how are you?
Yeah, I'm good. I'm good.
I'm sorry. I'm sorry. In this instance, you've got the graveyard shift in some respects, in that you're bringing us to the end. But Natalie, if we could please move on to the next slide. And in fact, even if we could go to the next one. So I want to. Okay. So, Johanny, just in terms of, we know there's a double tax agreement in place between the UK and the Ivory Coast. We're aware of that. It's one of the 24, and clearly, just like any of the other double tax agreements, you either satisfy the exemption criteria, or you don't. But in terms of immigration. I see that it's the employee rather than the employer is typically responsible for obtaining the work permit. Is that right?
Yes, that's correct. That's correct. Based right now, based on the rule immigration in Ivory Coast, it is foreign employee must have an employment prior to work commencement in Côte d'Ivoire, and then we need to have a stamp duty according to the employee nationality, and this stamp duty must be paid by the employer, and as well the employee must get a resident permit or a work permit, and it is the responsibility of the employee to get the work permit.
Okay, and I think the residence permit, is it that if you're not a national of ECOWAS, those countries basically, so someone coming from the UK would also need a residence permit, right?
Yes, that's correct.
Okay. Natalie, could we just move on to, okay, so if we just covered, we've assumed here no DTA exemption, right? Maybe
okay.
if you could just high level bring us through these slides, this particular slide.
Okay. In case there is no double tax treaty application, there will be an obligation for the company to pay the payroll tax, and then the rate is 12% for expatriate employees, and for local employees is 2.8%. So is more lower. And there is a deduction of 20, which apply to the gross income regarding the benefit in kind. We can say again that some exemption for expatriate employee can be applied when there is vacation leave cost. And there is an obligation to have a social security agreement. Social security application for all the non-resident entity and non-national employee in Côte d'Ivoire.
Yeah, and I was only when I understood the difference in the currency exchange rate. Natalie, could we yeah, just on this particular slide I saw, but I was relieved once I saw when we converted it to UK pounds. But I think the bottom line is there. Look, they're nominal amounts, Johanny. If we look at family allowance and work injury and disability, they're very small amounts when you think of them from a UK pounds perspective. But nonetheless, if you have a UK employer that's sending quite a few people in on an assignment, suddenly this could be a costing that they need to be mindful of. Of nothing else, there is the administrative burden from a social security perspective for Ivory Coast. I think though, for our listeners, I mean, Ivory Coast, in some respects, this highlights their small contributions when you convert them to UK pounds. There are other countries where it's not the same, where there is no earnings ceiling. The contribution rates might be similar or might be a little bit more, but there is no earnings ceiling, and then you can have a real otherwise hidden cost that you need to take account of. Okay. I think we've literally got 2 or 3 minutes left. If I could, Johanni, if I could just finish off, I've literally got a slide literally to finish off that's trying to just cover everything that we've discussed today and just put it as like UK, put it into a UK context. I think, look, I'll just pick out some of these because I don't think we've time to go through them all, but payroll tax obligations, definitely a consideration when you're sending people into Africa, almost a prerequisite in a lot of cases. Sending people on secondment for, depending on the period, you could have a continuing UK PAY liability at the same time. Think of the Appendix 5 agreement option to alleviate an otherwise cash flow burden. Of course, you can get into loaning the, you've got the 10 grand limit for fringe benefit purposes. You can consider loaning the tax to the individual, but you have a few different options. Just be mindful of them. The work visa goes without saying. The double tax agreement issue, again, goes without saying. Bonus earnings and employee share incentive vesting periods, I just put them in. Trailing income, you could have ongoing, these African countries adopt the same OECD principles. So workdays principle, looking at an earnings period, where were you working in respect to that earnings period? It might only be paid after you've left the UK, or indeed after you've left the African country, depending on which one. And the same issue arises around share incentive vesting periods. So just be mindful of them, that there could be tax payable in both jurisdictions after an assignment has finished. Natalie, if we could just go to the final slide, please. There we go. The second one there, obviously the first one is self-explanatory. We've covered pretty much all of the others. I just want to focus on two. Some countries in Africa tax on a residence basis, others on a source basis, and believe it or not, Eritrea is, I think, the only other country other than the USA that taxes on the basis of citizenship. Just know what the basis is. So again, it's doing your homework in advance. And I think the second last one is really important. Again, do your homework. Work out how much it's going to cost you. What is the real cost of sending someone on assignment to Africa, including the tax aspects? And I think that brings us to a close just about on time. If anyone has any questions, my contact details are on the front. I'd be very happy to field any questions offline and can involve my African colleagues at that point as well. But otherwise, thank you very much for listening in. Cheers.
I'm afraid we're out of time now, but a big thank you to James and his colleagues for sharing their knowledge with us today. As ever, the message is do your homework, as there are huge variations country to country. As I mentioned earlier, the recording will be made available to you shortly, together with the slides. And if you're on the GMPD programme, don't forget, fill in your learning log. So thank you, all of you, for joining us today. Goodbye.